Welcome to my channel. Before making an analysis video on Monday, I want to explain today's trade on what logic I gave you the trades today and what went wrong and why we triggered the stop loss. So if you look into today's charts, like it is completely sideways market. There is absolutely no opportunity at all to make the money today. If someone is declaring like they made the money, it is a false, and they are just fooling you. No one can make the money in this kind of a market. Yes, absolutely, there was a small trade somewhere here, like 20-30 points. Apart from that, completely the market was at a sideways range itself. No one would have made the money, and if someone is declaring like they made the money, it is completely false. Well, we'll go into the subject. First thing, like today, this morning, I gave you the call of 36,400 call options. So what is the logic behind of that? So yesterday we discussed like the market is in accumulation stage, and if the market opens flat, it will be in auctioning. If the market is opening a gap up, we might not get the trade. So the market has opened gap up and the price got sustained. So when the price has sustained at a higher levels, the people were now short here in the option selling. There are in options, like in derivatives, like in the options, there are option sellers and as well as the option buyers. So the people were now shorted here. Somewhere the people might have done straddle, some people might have done the strangle, or some iron condor, or different kind of strategies. Usually they do straddle and strangles, and someone were expecting like within 35,500 close itself because of the open interest and all that things. Most of the retailers might have shorted the market because they don't have the order flow charts to see with them. So they might have shorted, and they have to go for a cover here. That means like the people who have done like 35,500 call options when who shorted there, they have to come and cover their positions aggressively. So whenever they're coming and covering their positions aggressively, the market has to propel very aggressively at a higher side. So that was my intention, because when I saw this aggressiveness in the market, and when I saw the small pullback, so I said you to enter into the market. But later I have noticed like nothing was going on, and the price was just playing somewhere at a sideways market. So I said you to exit somewhere at cost to cost area itself. I said just come out of the positions, and I'm not seeing any kind of a price action on the higher side. So later again I said you to buy like 36,400 call options, because if you notice here the market went aggressively and little bit of an absorption, and the market has broken out on the higher levels. So somewhere at the top I said you to buy the call options, and later again I've noticed like the price was coming at a lower and lower levels. So in the price action we teach in the classes is like usually there are two different kind of price actions. So first price action is like when the market goes very aggressively at a higher levels, and the market accumulates for some time, and then it goes for an auctioning, which we call it as a pocket positioning. This is called as a pocket positioning. The market goes higher, and the market make another positioning in the market, and market goes at a higher level. So which we call it as a pocket positioning kind of a price action at a higher levels. Some people they call it as a higher highs like this. No, that doesn't work. That is kind of in a different price action, but this is the usual price action which we have. The market goes higher, it has a pocket positioning somewhere, and then market goes higher, you have a positioning again it goes at a higher levels. So this is one sort of a price action. And the second kind of a price action is the market goes very aggressively, and we have a very shallow pullbacks, and then market goes aggressively, we have a very shallow pullbacks, and it goes very aggressively. This kind of a price action happens very rare, because this kind of a price action is very much aggressive, and profit booking from the algorithms is very less, and there is not much of a positioning in the market. The market is very aggressive to either trigger the stop losses, or someone wants to get into the position, or someone want to hedge their positions. So based on that, this kind of price actions are there. So we will explain the different kinds of price action, how it works in a professional way, not just like layman words. We explain very professionally why the different kinds of price action works in our courses. So please do join it. Like it is not expensive, it is just $1,000. We explain how the real price action works. Well, today the price action was like I expected, like this was a price action when the market went higher, and there was a pocket positioning and the market went higher, and somewhere here I gave you the second kind of a call. So later I've noticed one thing was like the market was flushing at a lower levels. You can notice some people they call it as a flag, but usually I don't call it as a flag. And the market has to go higher. But when the market came here, the market was forming a wedge, You can notice very clear the market was a wedge. So it was in a confined small range, and later there was a breakout. So some people might have thought like, okay, the market is going at higher levels, and it is like the market is trending, because if you notice like here it is very much, some people might say like the flag absorption, flag again, the breakout at a higher levels, but this was completely a stop run. What we call it as a stop run. Stop runs, the absorption auctioning prices doesn't happen after the cash hours. So this is after the cash hours. After cash hours it doesn't happen. So we have different kind of strategies on what times the breakout happens and what basis the breakouts occurs. So this was out of the cash hours. I'll show you it a order flow chart as well. Bear for a minute. Just a second. So you can notice here this was a stop run. How do I know it is a stop run? You can notice there is no real offers been lifted into the market. You can notice there is no real offers has been lifted. There's absolutely no real offers has been lifted into the market. That means it is very much clear like this is a stop run. This is not a breakout or something. This is the stop run, which is meant for like to trigger the stop losses who shorted the market aggressively. So to cover their shorts, to take their profits, the algorithms, they just went higher, and I was expecting a flush again at a downside. So from here I was just giving you the put options itself, and rest like if you notice here, once again I tried to give you the put options because I was expecting the ledge to break here. I gave you the put option somewhere here and it failed. Again I gave you the put option here, again it failed. There was a failed breakout, and later again I tried my best to give the put option here. Again it failed, and I said you to come out of the position cost to cost. And I was not interested in calls anymore because there were not much of a shorts, and I was expecting a profit booking from the institutions because there is a big gap up. Just a second. The people who bought here, the big institutions have bought here. In this range, the big institutions have bought. The big institutions has to book their profits. They don't have the choice. They have to book the profits. So I was expecting a profit booking here, but someone were really buying. Later I realized like there was a buyer and he was buying, and yes, the profit booking has been taken by the other participants. So other participant couldn't bring the prices at a lower price, and other participants were some big institutions, they were buying and some big institutions were selling. So the market was in a confined range itself. So later I said like, please close your positions. Today is not the day for us. It is just for an option sellers day. And if you notice like whenever the market just broke this wedge, this was a stop run, and later the market came into this range, and it was completely a volatile market, and then again it started to break out. This was again a stop run, and later again the market flushed into inside the confined range, and you can notice like different sorts of false breakouts. I hope you like the analysis. Sorry, not the analysis. I hope on what basis I give the calls, because I'm explaining you in detail today. Some people might ask like, sir, we triggered the stop losses and we went for the loss. Yes, I have a logic. Based on the logic itself, I gave you the calls. I don't give the calls any blindly, or I don't give any kind of what do you call like just random trades. I usually don't do, because I've been doing my trading past from 8 to 9 years, I think, and I have a setup, I have a logic, and I think on what basis the market moves. Based on that itself, I give you the trades. I hope you understood it, like on what logic I gave you the calls. Well, we'll go into the Nifty chart. First, let me go into the Nifty today. So Nifty, just a second. So so if you notice into the order flow chart, the same thing, like the price opened, there was a shallow pullback from the algorithms, a little bit of a profit booking, not much of profit booking. Later the market went to the sideways, and there was a breakout. good amount of an accumulation taken place, and another breakout, and there was a shallow pullback, and again a breakout, and completely it was a sideways range itself. But net to net, like if you notice, good amount, not good amount of buying, like a marginal amount of a buying has been taking place in the market. You can notice the Nifty is okay, it has bought by some good big players. Well, if you noticed into today's structure, it was like Nifty was okay to make the money, but Bank Nifty was completely rubbish. And if I would say, like, no one would have been made the money at all. Well, what strategy we need to apply? If the market is opening flat and if it is crossing 17,350 levels, our first target should be like 17,500. So 17,500, it is a round figure. I would suggest you to book your positions, and let's don't trade. Or if you are still want to sit in your trade, because again, if the 17,500 it goes, the algorithms might come and try to take your profits, and market might come and it might go either sideways or it might go higher. But try to book your profits at 17,500 and close your positions. Don't hold the positions, because the people who now bought at a lower levels, again the people who now bought here, they might come and book their profits, so it will be difficult for you. So as the market crosses this swing like 17,350, we'll be looking to buy the market, and first target should be like 17,500. So if the market is crossing only this swing like 17,260 levels, just a second, let me see like what levels it is. Well, so 17,250, well, 17,250 levels, once it crosses, we'll be looking to sell the market, and first target should be like this swing 17,180, and next target should be like 17,000 levels, because there's a gap here, so market might come and fill the gap. I'm sorry. So market might come and fill the gap. So after 17,000, the market might come and fill the gap as well. 17,000, once the 17,180 crosses, like it might come even 17,100 and 17,000 levels as well. So it might come and fill this gap. We never know if the market is crossing this swing. Only on 17,250 levels itself, we'll be looking to sell the market. Sometimes what happens is, like, if the market opens flat, and sometimes it might come very aggressively at lower levels, and it might take the support somewhere here or below these levels, and market might bounce back. So whenever the market is turning over and it is crossing the today's swing or today's starting point, we'll be looking to buy the market. So gap up and gap down, again we have to see the price actions, because every day we are seeing a big gap ups and big gap downs. It is too difficult to predict like what will happen, because see, yesterday there was an accumulation in the market. The institutions have bought the market. When the institutions buy the market very aggressively, the next day they have to take the market at a higher levels. But what has happened today is like the market has opened gap up, so they don't need to put any kind of an efforts. So overnight they got this kind of a profit, like 200-300 points of a profit easily, and they even didn't book the profit, which is something like the big institutions are holding, like, and they're feeling this still it is a discounted price, so they might take the market at a higher levels. Well, if you look into the Bank Nifty chart, and I explained you very much, like nothing was there in the Bank Nifty, and not much of an activity was going on in the Bank Nifty. It was completely a sideways range. So what we need to do on Monday is like Monday we'll be looking to buy only about 36,600 levels, and the first target should be like 37,000 levels. And if the market is crossing like this swing 36,300 levels, I would say like better you cross 36,300 levels itself. Yeah, 100 points is nothing in the Bank Nifty. Let these 100 points come down very aggressively and let it cross this 36,300. Then we'll be looking to sell the market, and we'll target about first target should be like 36,000 levels, and later you can sit up until 36,800 levels as well, because the market might come and fill this gap. Well, I hope you like my video. If so, please do subscribe my channel and press the bell icon as well, and please do share with your friends if you like my video. Thank you, and thank you so much.